What price home can I afford is one of the first questions people ask when they start the home buying and mortgage processes. How much home you can afford is based on two things, the size of your down payment and the size of your mortgage. Your down payment is the money you contribute to buying the home, and your mortgage is the amount of money you borrow from a lender. Your down payment plus your mortgage amount equals how much home you can afford. Let's talk about each piece separately. I'm going to review the down payment first. The down payment is money that you put down when you purchase the home that you do not get back until you sell the home. So if something unfortunate happens, such as selling your home for less than what you paid for it, or your home going into foreclosure, then you could lose part or all of your down payment. So it's a pretty important part of the home buying process. There's no set rule for what size down payment you need to make when you buy a home, but there are some financial considerations you should be familiar with. In order to receive the lowest interest rate for your mortgage, most lenders typically expect a borrower to make a down payment of at least 20% of the purchase price of the home. For example, if you are buying a home for $300,000, if you want to receive the best interest rate, your down payment would be $60,000, or $300,000 times 20% equals $60,000. So a 20% down payment is the standard down payment amount when buying a home, but it is certainly possible to buy a home with a smaller down payment. If your down payment is less than 20%, the lender will likely charge a higher interest rate or require the borrower to purchase private mortgage insurance, which is also known as PMI. Private mortgage insurance typically requires that the borrower pay an ongoing annual fee on a monthly basis. PMI rates vary but can be approximately 0.5% of the mortgage amount for a 30-year loan when you make a down payment of 10%. Instead of charging PMI, some lenders may charge a higher interest rate. So the lender may offer you an interest rate of 4% if you make a down payment of 20% and an interest rate of 4.5% if you make a down payment of 10%. In many cases, paying a higher interest rate can cost the borrower more money than paying PMI fees because the borrower pays the higher interest rate over the life of the mortgage unless they are able to refinance, while PMI fees can be removed after the amount of your mortgage falls below 80% of the value of your property. So you can buy a home with less than 20% down, but it will likely cost you more in fees or increased interest expense. There are also multiple government-backed programs that enable you to purchase a home with less than 20% down, and we have a great overview of these programs on freeandclear.com. With the FHA home loan program, the borrower is only required to make a down payment of 3.5%, and the VA home loan program for active and retired military personnel requires no down payment. Both of these programs require the borrower to pay additional fees, however. There are a couple of other points to think about when it comes to your down payment. You also need to take into account mortgage closing costs in determining how much money you need to contribute to purchase a home. Closing costs vary by mortgage amount, program, geography, and lender, and can run thousands of dollars. Additionally, always remember to keep enough savings in reserve to cover 4 to 6 months of total monthly housing expense, so your monthly mortgage payment plus property taxes, insurance, and other applicable housing-related expenses. This will allow you to absorb any unexpected changes in your financial situation. Now, I'm going to discuss mortgage amount. We have a lot of great calculators on freeandclear.com that help you to determine what size mortgage you can afford, but I'm going to discuss some of the fundamentals you should keep in mind. There are 3 key numbers to think about when it comes to determining what size mortgage you can afford. The first is your monthly mortgage payment. The second is total monthly housing expense, which, as we discussed, is your monthly mortgage payment plus property tax, homeowners insurance, and other housing-related expenses. The third number is total monthly housing expense plus other monthly debt, such as credit card, auto, and student loan payments. There are no strict rules on how much of your income you should spend on these figures, but there are some general guidelines that we can apply. Borrowers typically spend a maximum of 43% of their net income on their monthly mortgage payment, a maximum of 52% of their net income on total monthly housing expense, and a maximum of 62% of their net income on total monthly housing expense plus other monthly debt. I want to emphasize that we are talking about net income, or your income after deductions such as taxes, Social Security, and Medicare, so your take-home pay. I'm going to walk through an example to demonstrate how the guidelines work. Let's say our borrowers make a combined $5,000 a month in net income. 43% of $5,000, or 0.43 times $5,000, equals $2,150. So the borrower can afford a monthly mortgage payment of $2,150. Next, we have total monthly housing expense. 52% of $5,000 equals $2,600. So the borrower can afford to spend $2,600 on monthly housing expense, which means we're spending approximately $450 a month on non-mortgage related housing expenses such as property taxes and homeowners insurance. Finally, we have total monthly housing expense plus other debt. 62% of $5,000 equals $3,100. So the borrower can afford to spend $500 a month on other debts such as credit card and car loan payments. Let's look at a second scenario now. Let's say our borrowers still make $5,000 a month, but they don't have $500 in monthly debt. Instead, let's say they only have $250 in monthly debt. That means our borrowers can spend more on total monthly housing expense and their mortgage payment. This time, we're going to start with total monthly housing expense plus other monthly debt and work our way up. Because our monthly net income does not change, our borrowers still spend $3,100 a month on total monthly housing expense plus other debt. But because we only have $250 in monthly debt instead of $500, our borrowers can now spend $2,850 a month on monthly housing expense. And keeping our non-mortgage housing expense constant at $450 a month, they can now afford to spend $2,400 on their monthly mortgage payment, up from $2,150. The higher your monthly mortgage payment, the larger the mortgage you can afford. After you determine what size mortgage payment you can afford, you can figure out what size mortgage you can afford. Let's continue with our example and say that our borrowers can afford a mortgage payment of $2,400. What size mortgage our borrowers can afford depends on the interest rate and term or length of the mortgage. Let's look at a 30-year fixed rate mortgage, which is the most common type of mortgage, and 3 different interest rates: 4%, 5%, and 6%, and show what size mortgage our borrowers can afford at each interest rate. With a 4% interest rate, our borrowers can afford a $500,000 mortgage. At 5%, a $445,000 mortgage. And at 6%, a $400,000 mortgage. As you can see, the lower the interest rate, the higher the size of mortgage our borrowers can afford. And as this example shows, our mortgage affordability guidelines are not set in stone, but rather can be influenced by several factors. So now, let's return to our original question of what price home you can afford. Let's use the 4% interest rate scenario and say that our borrowers can afford a $500,000 mortgage. The question then becomes, what size down payment can we afford? Let's look at 3 scenarios, with the borrower making down payments of 5%, 10%, and 20%. At 20%, our down payment is $125,000. At 10%, our down payment is $55,555. And at 5%, our down payment is $26,315. Now that we know our down payment and mortgage amount, we can determine what price home we can afford by adding the two figures together. With a 20% down payment, we can afford a $625,000 home. With a 10% down payment, we can afford a $555,555 home. And with a 5% down payment, we can afford a $526,315 home. Now that you understand the fundamentals behind determining what price home you can afford, we encourage you to check out our mortgage qualification and down payment calculators, and also review our mortgage process guide and first-time homebuyer program overview on freeandclear.com. Thank you for reviewing What Price Home Can I Afford with freeandclear.com. Freeandclear.com.